Oil rig count and its impact on oil prices. What is the oil rig count? The oil rig count refers to the number of active drilling rigs exploring for or producing oil. It is a critical indicator of the level of activity in the oil exploration and production (E&P) industry. The count is typically reported weekly by companies like Baker Hughes, which provides one of the most widely followed rig counts in the industry. Active rigs. These are rigs that are currently drilling for oil. Idle rigs. These rigs are not currently in use but can be reactivated if demand or prices rise. How oil rig count affects oil prices. Supply implications: higher rig count. An increase in the number of active oil rigs generally suggests that oil production is likely to rise in the future. As production increases, the supply of oil in the market may also rise, which can lead to lower oil prices if demand doesn't increase correspondingly. Lower rig count. Conversely, a decrease in the rig count typically indicates that production may slow down in the future, reducing the supply of oil. This reduction in supply can lead to higher oil prices if demand remains constant or increases. Market sentiment and speculation. Indicator of future production. Investors and traders closely monitor rig counts as a leading indicator of future oil production. A rising rig count can signal that companies expect higher oil prices or strong future demand, leading to more exploration and drilling activities. Conversely, a falling rig count might indicate expectations of lower prices or weaker demand, prompting companies to scale back production efforts. Price volatility. Changes in the rig count can lead to short-term price volatility. For instance, a significant drop in the rig count might spur concerns about future oil shortages, driving prices up. On the other hand, a sharp increase in the count might lead to fears of oversupply, putting downward pressure on prices. Costs and investment decisions. Cost of production. The rig count also reflects the economic viability of oil production at current prices. When oil prices are high, more rigs become economically viable, leading to an increase in the rig count. Conversely, when prices fall, the cost of operating some rigs may outweigh the benefits, leading to a reduction in the rig count. Capital investment. Oil companies use rig counts to make decisions about where to allocate capital. A rising rig count can indicate that companies are willing to invest more in exploration and production, reflecting optimism about future oil prices. A declining count might signal reduced investment and a more cautious outlook. Lag between rig count and production time delay. There is often a time lag between changes in the rig count and actual changes in oil production. Once a rig is activated, it can take weeks or months for it to start producing oil. Similarly, even if the rig count drops, existing wells may continue producing oil for some time before the overall supply is affected. Long-term trends. For this reason, while the rig count is a useful short-term indicator, it should be interpreted in the context of longer-term trends and other market factors. Impact of technological advances. Efficiency. Gains. Advances in drilling technology, such as horizontal drilling and hydraulic fracturing, fracking, have made oil production more efficient. As a result, fewer rigs are needed to produce the same amount of oil. This means that a lower rig count today might still result in higher production compared to the past. Shale oil impact. In regions like the U.S., where shale oil is prevalent, the relationship between rig count and production can be complex. Shale wells can be brought online more quickly than conventional wells, leading to faster responses to changes in oil prices. Conclusion. The oil rig count is a key indicator in the oil market, providing insights into future oil supply and the overall health of the E&P sector. While changes in the rig count can influence oil prices, the relationship is not always straightforward due to factors like production lags, technological advancements, and market sentiment. Investors, traders, and policymakers use rig count data to gauge potential shifts in supply and adjust their strategies accordingly. However, it is important to consider this data in conjunction with other factors affecting the oil market, such as global demand trends, geopolitical events, and technological changes.